when the Federal Reserve initially started setting on their policy of tightening in early 2022, in spring, I talked about recession in my newsletters. And, that whole year was indeed terrible for asset prices. And it was most economic rate of change indicators were slowing down all throughout 2022. Now, what started to change in early 2023 and to some extent in very late 2022 was that this ongoing tightening by the Federal Reserve, even though it had killed certain industries, or at least killed certain asset prices and certain types of inflation, the fact that it was now resulting in larger deficits because of that heightened interest expense.
Financial expert Lyn Alden delves into the intricate web of economic policies shaping the world in 2023. She highlights the Federal Reserve's tightening measures in early 2022, causing a recession scare and plummeting asset prices. However, a surprising twist occurs as 2023 unfolds. The ongoing tightening, intended to curb inflation, leads to unforeseen consequences. The Federal Reserve's interest expenses rise, widening deficits and creating a unique economic landscape. Lyn explains how this unexpected scenario affects various sectors differently, from commercial real estate to tech companies and consumers. But amidst this complexity, there's a crucial factor at play. Global dynamics, such as China's hesitant recovery, add pressure to the world's inflationary trends. As Lyn unveils the intricate balance of forces shaping economies, what awaits in the next chapter of this economic saga is nothing short of fascinating. Stay tuned to discover the surprising twists and turns that could impact your financial future.
Basically, the federal government debt had given enough time to start maturing and getting refinanced at these higher rates. And Federal Reserve's operating at a loss. They're the opposite of ExxonMobil. ExxonMobil's assets pay higher interest rates than their liabilities. The Federal Reserve is paying higher interest rates on its liabilities than it is earning on its assets, and that's money that's pouring into the economy. And so, as these various liquidity effects started to actually impact it, we got this weird environment where, so throughout 2022, the deficit was shrinking as a percentage of GDP. We had fiscal contraction, but in 2023, it started widening again. And that's in large part because of interest expense. So by pushing down asset prices, at least for temporarily, that hurt tax revenue. And then it also increased interest expense. So both on the budget, on the revenue side and the expenditure side of the federal government, it increased deficits. And generally speaking, when you have a recession, governments increase their deficits, either because their tax revenue collapses, but they keep spending, or because they also increase spending as a form of stimulus. Now, before this recession could even materialize, we're running, $1.5 trillion or $2 trillion deficits, like, 6 to 8% of GDP deficits before the recession's even here. And that actually, it's kind of challenging to have a recession when you're pre-stimulating to that degree. Mm-hmm. Now, you can still have one, especially in real terms. That's how recessions are defined, but it extends the negative impact you need from the private sector in order to have a recession. It keeps kind of pushing the can down the road. It makes it so that inflation falls a little bit less quickly than we think, and it makes it a recession is kind of pushed out for a period of time. And so that's kind of where we find ourselves right now, where monetary policy is trying to be very tight. And like I said before, on certain areas, it certainly is. Commercial real estate, junk-rated companies, unprofitable tech companies, these have been a truly, disinflationary, deflationary type of area. Whereas, services, investment-grade companies, upper middle-class consumers, these have generally not been heavily impacted. And if anything, are that interest expense and the overall large federal deficits are flowing to them. And so they're able to keep spending, keep consuming. And we've had various inflationary offsets, like, oil was very expensive. So, we drew down the Strategic Petroleum Reserve. China has been slow to come out of its kind of COVID slump. They're actually doing the opposite of us, where their monetary easing is easier than ours, but they have a very tight fiscal situation. They're not stimulating fiscally, which is the more powerful tool. And so China is pretty slow right now in terms of consumption and things like that. So that's a disinflationary pressure for the world.
In this next segment, Lyn Alden provides a deep dive into the intricate world of economic policies and their impact on various sectors. Initially, she explores the Federal Reserve's tightening measures, sparking recession fears and causing a downturn in asset prices. However, a surprising turn of events occurs in 2023. The ongoing tightening inadvertently leads to larger deficits due to heightened interest expenses. This unexpected scenario creates a unique economic landscape where specific industries, such as commercial real estate, face recessionary challenges, while others, like investment-grade companies, thrive. Lyn emphasizes the need for precision when considering recession, urging viewers to focus on industries rather than a broad economic downturn. She also delves into the world of investments, discussing the interplay between gold, real estate, Bitcoin, and other assets, examining their growth concerning money supply.
That has been a truly disinflationary force, especially for energy markets, at least temporarily. The problem is that I think a lot of that is done now. And so as this ongoing thing continues, we're seeing a re-acceleration of some energy inflation. And so when you're not offsetting these deficits with something else, that's when you can get a bottom in inflation and you can actually start to roll up in inflation. So I think that that's something to monitor going forward. So we basically have these two very powerful forces. And instead of thinking in Boolean terms of recession or no recession, I think we have to be very specific on the industries we're talking about. So commercial real estate recession, absolutely. Recession in restaurants, maybe not. Maybe it's a no recession in restaurants. Is it a recession for investment grade companies that are earning more interest on their cash than their debt for like in the first time in modern history? They're not complaining in this environment, right? So I think that we have to be very specific with the industries we consider when we talk about recession, and then of course whether or not it becomes a true recession is when you add that all up. Is that are we reducing our number of employees? Are we reducing our real GDP or not? So far the answer has been no. Although of course this type of data is subject to revision. We could even be in a mild recession right now and we won't know until months from now. Like if you go back to the Great Recession, if you take the U.S. money supply growth and you subtract the annual gold supply growth, you generally get the answer for what has gold appreciated over the past century per year on average. That differential. Now, obviously, every year it's not going to be that smooth. There's gonna be a decade where gold is flat. People are they're distracted elsewhere, and then it kind of all catches up at once in another decade, right? That's generally how we've seen gold operate. But on a long-term basis, that generally tends to be the case. The one challenge to think of is that you have to look at the different things that people can store value in. So you have to say, okay, there's gold, there's real estate, there's Bitcoin, there's art. So you kind of look at that whole market and you say, okay, that market is likely to kind of grow in line with money supply over the long run. And then the question is, among those different competing assets, which ones are going to eat into market share of others, right? Is something going to get more people interested in gold? Is something going to get more people interested in Bitcoin? Is something going to get people more interested in focusing on real estate? If and you can make different arguments as to why. If India's GDP doubles, culturally they very much like precious metals. They have a long track record of that. They're going to probably want more precious metals. On the other hand, if Bitcoin continues to grow at the rate of it generally has, it clearly is chipping into some demand for gold and silver because now as a capital allocator, pre-Bitcoin I'd have gold and silver. Now I can say, okay, well, gold, silver, and Bitcoin, right? And so what percentage do I want to have in either? So it kind of fractures the market share a little bit. But in general, I think that's the way of thinking of it, is comparing those different supply growth rates and then determining among those tight supply things, what is more attractive.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.